Hello and welcome to another video. I'm Daniel reporting live from Gothenburg, Sweden. This is not financial advice, it's just me going through my own valuation thesis and opinions about stocks and other things finance here on YouTube. Today we're gonna go through the American grocery market. This is a huge market, it's a $1 trillion market. Me, myself, is a pretty big stockholder in Sprouts Farmers Market. Kroger's earning is coming up right now, and we're gonna go through Kroger a little bit, and we're gonna compare them to the other big retailers out here in America and see which one could be a good investment or not. So if you look at the top list here, the biggest retailers here in the US, you have Walmart. They have 4,600 stores and a revenue of $674 billion. You have Costco, which impressively only have 629 stores with $275 billion in revenue. That is amazing. You have Kroger, 2,700 stores, Target, 1,960 stores, Albertsons, 2,200 stores, Publix, 1,400 stores, H-E-B, 400 stores, Aldi, which is a big, massive, explosive growth German company. They have 2,500 stores right now, and they are growing like crazy. Trader Joe's, 570 stores, and we got Sprouts Farmers Markets at 477 stores. Very, very small players here. So just this last year, Kroger tried to merge itself with the Albertsons, so they would combine the stores, 2,700 and 2,200 stores. It would be 4,900 stores, but they were denied by the US. They thought they would be too competitive, while their own argument was that they are not able to compete with Walmart as it is. But the US did not think the same, so they were not able to combine their own stores. So they are separate for now. So what separates these entities? You have Walmart. It's all about price and convenience. 90% of Americans live within 10 miles of a Walmart, with AI-driven logistics, same-day delivery, and grocery penetration reaching a record 72% of US households. They are the gravitational center of American grocery. Costco, the anti-grocery store. No frills, no coupons, no fancy displays, just 3,700 SKUs compared to 30,000 plus a typical supermarket at razor-thin margins. Costco doesn't make money on products, it makes money on $65 a year membership fees. Renewal rate 93%. That is amazing. That's a subscription business disguised as a warehouse. Kroger, their classic American supermarket, but at a scale that most people don't realize. Under banners like Fred Meyer, Ralph's, Harris Teeter, and King Soopers, Kroger serves 11 million customers daily. Their moat is data. The loyalty card program and partnership with dunnhumby gives them granular insights into shopping behavior. They also operate manufacturing facilities, fuel centers, and pharmacies. Target, not a pure grocer, but increasingly relevant. Grocery now drives significant traffic, struggling with 13 consecutive quarters of weak or falling comparable sales overall, but food and beverage is a bright spot. Albertsons, the acquirer, built through decades of merger and acquisitions. Safeway, Jewel Costco, Jewel Osco, Shaw's, Acme, etc. Albertsons is the second largest traditional supermarket operator. The failed Kroger merger in 2024 left them independent and now pivoting to AI and digital. 49.8 million loyalty members and growing. Publix, the employee-owned darling. If you've ever lived in the Southeast, you know Publix wins on service, store quality, and culture. 260,000 employees are all partial owners. This drives long-term thinking over quarterly pressures. H-E-B, the Texas King, privately held, fiercely regional, and ranked #1 US grocer by dunnhumby 5 out of 9 years. Known for exceptional store experience, strong private label, and deep community roots. If they ever went national, every grocer in America would lose sleep. Aldi, the European disruptor that's quietly becoming America's fastest growing grocer by store count. The model is brutal simplicity. Small stores, limited selection, and prices 20 to 30% below conventional supermarkets. They're targeting 2,500 US stores and expanding rapidly into new markets. Trader Joe's, the cult favorite. Small stores, curated selection, and almost entirely private label. No loyalty program, no coupons, no e-commerce, just a treasure hunt shopping experience that inspires near religious devotion from customers. Owned by Aldi Nord, separate from Aldi Sud, which runs Aldi US. And we got Sprouts, the specialty play, healthy conscious consumers, natural and organic products, smaller format stores, 23,000 square feet, opened 37 new stores in 2025 alone, and has a long target of 1,400 locations. So if we look at the numbers on these grocery giants, we got 5 important numbers. We got revenue growth. Are they actually growing? We got EPS growth. Are they making more money year on year? Free cash flow growth. Are they able to grow their free cash flow year on year? Book value per share growth. Is equity growing per share? And return on invested capital. Is the company actually good at getting returns on the thing that it puts its money on? So if we look at Walmart, they are growing 5 to 6%, EPS growth 8 to 10%, free cash flow growth 9%. Book value per share growth declining, which could be explained on an aggressive stock buyback program, share buyback program. Return on invested capital 13 to 15%. That is all good. We got Kroger. We get a 2% revenue growth. That is not growing. That is staying alive and keeping itself neutral in the growing discussion at least. Earnings per share growth, they are staying flat-ish. Free cash flow growth, that is volatile, so I would call that flat as well. We have book value per share growth, low single digits. That is not good. Return on invested capital, 8%. Also not too good. If we look on these 5 important numbers and in a vacuum for a little bit, this is what we have. 10-year return on invested capital, we get 8%. That is not catastrophic, but it's not over 10% that we would like to see. Top line revenue, 3%, and year on year we have minus 2%. That is not nice. Free operating cash flow, we have minus 38% if you look into 1 year back, and that could also depend on the fact that they're maybe investing a lot in future growth right now. But all in all, this is pretty weak if you look at a company overall. You want to have over 10% return on invested capital. Even though this is a big retail chain, you do want that because the less percentage you have on the return on invested capital, either they are elevating their size too much or they're simply taking too many bad financial decisions with their money. And that is not nice. Top line revenue, like 3%. This is not a growing company as it is right now. It's not the most expensive stock either, but for me, if a company is not over 10% return on invested capital and they're not growing as it seems right now, it's a no-go for me. You want to see the company growing, or you invest in it in some other thesis, a thesis that I do not use. I invest in companies that are growing. I invest in companies that has over 10% return on invested capital. I invest in companies that actually raise their earnings per share growth here, which they have 7% the last 10 years, 3% the last 5 years, 1 year 24%, and trailing 12 months minus 70%. So that is quite choppy. Then we have Costco. Costco is really delivering on all the numbers. They have extremely good numbers. Revenue growth 10 to 12%, earnings per share growth 13 to 15%, free cash flow growth 8 to 10%, book value per share growth 10 to 12%, return on invested capital 20 to 23%. That is insane numbers. But at the same time, you do have to pay a huge premium on this company. And they're trading at 50 times for a PE. That is quite a lot. Generally, I base my future growth on the book value per share growth. In Costco's case, you have a 10 to 12% book value per share growth, and they're valued at 50 times for the PE. I would pay 24 PE on this company if it has a book value per share growth of 12%. Yeah, so here's their numbers. Really good. Top line revenue, not insane, but stable, 10% over the last 10 years, approximately. Free cash flow is insane, 32% year on year for the last 10 years. It's gone down. The last year is 18%, insane. 1 year book value per share growth 23%. So, maybe you could give this company a PE of 30, but not 50. 50 is too high. Albertson, we have weak numbers here. Sorry, we have revenue growth 3 to 4%. That is weak. Earnings per share growth 3%. Free cash flow growth negative. Book value per share growth. Return on invested capital 6 to 8%. That is not good enough. And then we have Sprouts Farmers Market. They are doing very, very well for themselves. We have a revenue growth between 8 to 10%. Earnings per share growth 15 to 20%. Free cash flow growth, strong double digits. Book value per share growth, double digits. Return on invested capital, 15 to 20%. So as you can see here, the numbers are insane. 10 years earnings per share growth is 23%. This is just crazy, crazy numbers. And Sprouts is valued at, I don't know, like 12, 13, 15 times. They are pretty cheap right now. And they have very, very, very good numbers. And to me, it's very nice when the company is not as big as the other ones are, because it's very, very hard for the big ones, Kroger and so forth, to put up these really huge numbers when they come from this big size. It's easier to grow fast when you're smaller. That's just the nature of it. But of course, one could argue it's maybe harder for you to maintain your competitive advantage when you're smaller. You don't have the size for being able to get the prices down on your groceries and so forth. But I don't deem that to be the biggest issue with Sprouts, due to the fact that they are operating in a niche inside of the food market. So I really like Sprouts numbers, and that is why I have a sizable position in them. I think it's a very, very good bet right now. So when you look at the store growth, who is expanding? And generally you have net closures on Walmart, you have net closures on Kroger. It's only Costco, Publix, Aldi and Sprouts that's growing in this segment. The other really, really big ones is sizing down a little bit. And depending on what you want out of your investment and what kind of investor you are, maybe you suspect that like Walmart are decreasing their store size. I don't know what the valuation thesis is. To me, I buy growth and I want to see the companies growing stores. So the Kroger upcoming earnings, they do expect earnings per share to be $1.20, up from $1.40 in Q4 2024. Estimated revenue to be $35 billion, 2.5% yearly increase. Generally, since their merger didn't fell through with the Albertson, the market is looking at, are Kroger able to regain organic growth inside the company? Right now, the market is expecting them to post growth of between 2.7 and 2.8%. Overall, generally, they want to see the management talking about getting the company back to solid organic growth for the company. They're still just half the size store counts wise to Walmart, so they should be able to get out more organic growth inside the business overall. And this is the thing the market is looking at a lot when it comes to Kroger right now. So that's it for this video. I hope you found some value in it. I wish you the best of luck with your investments. Elsewise, you have a great day.